Okay, so we're going to go over a form of seller's exhaustion, and you can use this for swing trading, day trading, scalping. It just depends on what time frame you're on, and this works on every time frame. So what this is basically sellers are driving the price downwards, and buyers, they're not really fighting it. The sellers are just they're outnumbering the buyers by too much, and there comes a point usually at a critical uh, kind of supply zone. So in this case it would be the 200 EMA, and then the buyers really step in and then drive the price the other direction, and this is a reversal. So what you want to look for is a downtrend over the course of a few candles. So in this case, it's like 2 weeks of selling, and then it crosses this 200 EMA, which is where I'm sure a lot of people had their stop limits or their limit buys placed, and then also a lot of speculative buyers saying, okay, this is where I'm going to be stepping in and buying more shares, because how many people want to own the stock at the 200 EMA? Look at how often it does not touch that. So this is an excellent example. So it starts to come down, and then it's struggling here. You can see this wick, this massive wick. That's generally the first sign that you've hit seller's exhaustion, where the sellers start to get outnumbered by the buyers, or there's just not enough people selling. They start to see value in the stock at this price. So this wick here is really where you start to pay attention. Now, the following day, you can see it did open up here, and then it went all the way down to 461. So that is a $40 drop, about 10%. And then the following day, it basically gapped up above the 200 EMA. And then from there, it has remained above that level ever since. And that was March 9th. So I'll bring up Tesla. And so on Tesla, you can see something very similar happened here. So we have a few days of selling, these solid body candles. Now we're starting to get some wicks, and we have this super long wick right here. And again, we're approaching this 200 EMA. So once we're approaching that, you get this very long wick. Buyers start to step in over here. You can see it didn't go as low as this wick over here. And the following day, gapped up, massive gap, or massive candle, going from almost 600 to 676. So what is that? Around 12-13% gain just on this candle alone. And then from there, it stayed relatively strong. It stayed kind of in this range here. It's just now touching the 200 EMA, but this was done a little bit more steadily and a little bit more, stable. So this is not something that you would consider seller's exhaustion. It didn't have this just rapid sell-off where it's way oversold way too quick. You can see that this was done on a relatively large volume here, and then this one was sold off on pretty average volume, nothing out of the ordinary. But you can see down here these volume spikes, that's higher than average. So this middle line is the average volume. You can see these spikes here are higher than average. The valley beneath it would be lower than average volume. So these just had an insane amount of volume. And again, that's what you want to look for, higher than average volume on the selling. So I will move on to SPY. And it can be done with as little as 3 candles right here. So you can see solid candle, you're starting to get that wick down, and then it bounces right off of this trend line. So again, this is a crucial point for it. And then you can see here, these 3 candles, there's, about average volume, and then increasing volume, and then massive volume. It's the highest candle kind of on the chart. You can see here the average, or the other highs were kind of in this range here. This one's peaking above that quite significantly. And then the following day, it opened up on this trend line again. So it was holding that important key level. And then from there, it wicked all the way up, and then it started its uptrend. So Like I said, it can be done with as little as 3 candles. It can be done with 1 candle if you're on a smaller time frame. Just look for anything that's pretty much oversold on higher than average volume, and then you get that wick back up. That's when it should go on your radar. So if you don't have that wick, you can check in on it every once in a while. But for the most part, the most important thing is higher than average volume, and then start to look for those wicks. A lot of the times it'll wick up, have one more red candle, and then it reverses. But for the most part, those are the two things you need to look for. And then the same can be said with buyer's exhaustion, because the same thing happens. I don't necessarily have any examples on this chart. I guess right here, so you can see buying. You don't really have these crazy top wicks, but it's the same exact thing where there's no sellers. The bull market is just too strong, and all the buyers are stepping in, and then all of a sudden it goes up too quickly, and sellers start to go, okay, you know what? We're not going to let it go this much higher. And then sellers step in, and the exact opposite happens. So it's just a reversal pattern. Super important to know. And it's great for scalping if you just want to kind of speculating that that's the dip, it's holding this key level, I'm going to buy some calls, and you ride it all the way up, and IV will be pretty high, so that should compound the deltas a little bit. But it's an excellent tool to be able to identify.